At this point in the Roper Outfitters problem, we have determined that Roper Outfitters' decrease between their actual contribution margin and what was budgeted for can largely be attributed to the fact that there's a huge sales volume variance, which was caused by an overall decline of their sales and not so much to selling the wrong mix of products. Well, what reasons could cause a company to have an overall decline to their sales? It's got to be one of two things. Either the market as a whole, the willingness of people to want to buy, in our case, rustic apparel, decreased, or our share, there's more companies than us that make rustic apparel. Our share of that market that we are capturing is well below expectations. So let's dig further here and figure out if this huge decrease in contribution margin caused by our sales volume is attributable to our share of the market being off, or if the size of the market that we estimated was off. There wasn't the demand for rustic apparel that we thought there was going to be. And I'm going to start over here by figuring out what our actual market share was versus what our budgeted market share was. It tells us in our information that at the beginning of the period, our company estimated or budgeted that the total market would be 160,000 pieces of apparel. But in actuality, the market size was 167,500. I can already tell you right now, this is not good if our sales went down and the market was actually bigger than you thought it was going to be. Let's put it into percentages. What was the actual amount of those 167,500 pieces of apparel that were sold in the market that came from Roper Outfitters? Well, Roper Outfitters' actual quantity of all sales sold, all units sold, was 13,400. We had estimated in the beginning that we were going to sell 16,000 units. So, stick with budgeted right now. We estimated that 16,000 out of the 160,000 pieces of rustic apparel that were sold in our market were going to come from us, or we were going to capture 10% of the market. So just our budgeted sales divided by total market, budgeted total market size. In actuality, we sold 13,400 units out of the 167,500 pieces of apparel which were sold in our market. So Roper Outfitters' actual piece of the pie, their actual share of the market, was only 8%. Well, now we got to figure out what our budgeted average contribution margin per unit is. And that is basically us finding the average unit or average margin we get off of one unit sale, regardless if it's boots, jeans, or hats. So it's the weighted average margin across all of our sales. And to find that, we take our total budgeted contribution margin. We estimated in the beginning, if I scroll way back up, that our total contribution margin in the budget for the quarter was going to be $340,000. We also budgeted that we were going to sell 16,000 pieces of apparel in total. So in order to generate $340,000 of margin off the sale of 16,000 units, we expected that any one unit that we sold, be it boots, jeans, or hats, was going to give us a margin of about $21.25. And now that we have those two pieces of preliminary information ready, we can do our market share variance and our market size variance. For market share variance, we're going to need our actual market size, and we already have that. We know that in our market there was actually 167,500 pieces of apparel sold. We also know that we actually captured 8% of that market. Roper Outfitters sales was 8% of overall rustic apparel sales in our market. That was well below the 10% that we budgeted for. And then we also know that according to our budget, we expected any one given product sold to have an average contribution margin of about $21.25. And the same thing that we did above. When two things are likewise, like an actual something versus a budgeted something, you find the difference between those two and you multiply it by the other inputs in the formula. So for this formula, it's going to be actual market times the difference between the actual share and the budgeted share times our budgeted average contribution margin per unit. And I put that into my formula here. Take this and multiply it by the difference between our actual market share and our budgeted share. And then I multiply that by our budgeted average contribution margin per composite unit. And I come up with an unfavorable market share variance of 71,188. And it should definitely be unfavorable because our share of the market was much less than expectations. Like if we ended up being 10% of actual sales in the market, we would have sold 16,750 units, 10% of that number, and that would have increased our overall contribution margin by $71,188. Or it would have been $71,188 higher had we been 10% of sales. So a huge portion of our loss in overall contribution margin is definitely attributable to the fact that people were buying from our competitors and not buying from Roper Outfitters. What about market size? Well, the actual market size we have here was 167,500. When we set our budget forth at the beginning of the third quarter, we expected there to be 160,000 units sold in this market for rustic apparel. And we also expected that we were going to be 10% of those units, and that any one unit we sold was going to give us a contribution margin of about 21.25. So same thing. We got two things that are similar here: actual market size and budget market size. Let's find the difference between those two inputs and multiply it by the other two. So we got our actual market minus our budgeted market times our budgeted share times our budgeted contribution margin. And when we math this out, we come up with the fact that the actual market was 7,500 units bigger than we thought we were going to, the difference between those two numbers. If we got 10% of that, we should have sold an additional 750 units. And those additional 750 units sold, 10% of that difference, with each unit giving us a margin of 21.25, means that overall, because the market was bigger, if we captured the share that we thought we were going to and got the margin per unit sold that we thought we were going to, that increase in the market size should have increased our overall contribution margin by $15,937.50. And if I add these two numbers together, I'll do it in this cell right here, this one plus this one, I come up with $55,250. Does that look familiar? It absolutely does. It is our total sales quantity variance. So our problem was sales quantity. We didn't sell as many units overall as we thought we were going to. Is that because the market wasn't there for our particular product that we sell, or because we didn't capture the market and we lost ground to our competitors? And we see down here, it is absolutely not being able to capture the portion of the market that we thought we were going to. So in a paragraph, commenting on these results is exactly what I would say right now. The mix was good. We sold a higher level of our more profitable product than we thought we were going to. The market was bigger than we thought it was going to be. Our problem, and our problem solely, is the fact that people are buying from our competitors, they're buying from Wrangler or whoever, and not Roper Outfitters. We need to do something to increase our share of the market, and then more likely than not, that is going to have to come through a combination of sales promotions and extensive advertising.